We're going to talk about cryptocurrencies next. Ajeet Khurana, Bitcoin expert and founder of Genezis Network, is joining in. Ajeet, thank you so much for waiting by. Apologies for keeping you waiting. But I want to talk about the current context, right? You have a situation where even today you have cryptocurrencies across the board that are being sold into. Why is this happening, especially at a time when you're talking about cryptocurrencies having been pegged as an inflation hedge and inflation is running riot?
Absolutely. That's a very good point. Being an inflation hedge, being a non-correlated asset, which actually is showing very high correlation with the stock market, etc., are all contradictions of terms. Fundamentally, what I have found is that being an inflation hedge or being a non-correlated asset works in situations where the money supply or interest rates are relatively stable. Otherwise, when liquidity is pumped into the market or pumped out of it, liquidity becomes God and drives prices in both directions.
So what you're essentially saying, Ajeet, is that there was a significant amount of liquidity in the system. A chunk of that liquidity, because of the amount of money available, has gone into these alternate assets, cryptocurrencies in general, and that pushed the prices up because of the demand scenario. Now that money is getting sucked out and those assets are being sold into, and this is kind of being perpetuated. The fall in price is accelerating the selling, and that is accelerating the fall in price. Is that a summation that is accurate?
Yes, and I can give you a numeric basis for that. October 19, Bitcoin is at $8,000. We have COVID, liquidity is pumped into the market. April 21, which is just 6 months later, Bitcoin goes 8x to 64,000, goes to 68,000 in November 21. Liquidity gets sucked out with the Federal Reserve move and others, and Bitcoin is down to 20,000. So very strong correlation with liquidity.
Any point then see that correlation changing, or do we see these cycles continuing in perpetuity?
Given that almost the entire volume that you notice on cryptocurrency exchanges is trading volume and not investing volume. I don't have, actually, nobody has the exact numbers, but I think that investors are far, far less than 1%. I would be surprised if they were even 0.1%. As long as this remains, the presence or absence of money in the market will continue this high correlation with liquidity.
Okay. Is there a case then for investors to, or individuals that believe in the long term? I won't say investors, that's a broad term. I will say individuals that believe in the long term prospects of cryptocurrency. And here I'm specifically talking about the stable coins, the ones that have a larger use case. Do you think that there is still a case for them to buy and hold?
So stable coins, frankly, are the less important part of this segment. They allow people who hold digital assets to move on to a pegged asset if they don't want to take a position. So that is really the only very limited purpose it serves. The reason they are famous is because fiat currency is pegged to it. I would say, in my opinion, if you look at April 2022, which is very recent numbers of Facebook, it had 2 billion daily active users. All cryptocurrency apps across all blockchains put together had around 1,000th of that. That is Facebook on the one hand and all apps on the other end. If you think Web3 is about to die, well, that's one view. But if, like me, you believe Web3 will eventually become very famous, then the headroom available is significant over the next few years.
But is Web3 going to be the primary use case for alternate assets, for cryptocurrencies? Or will there be more that will emerge?
So I think that if you look at blockchain as a whole, then private blockchains will be used by governments for Aadhaar card like things, land records, etc. But if you look at public blockchains such as Bitcoin, Ethereum, Solana, Cardano, Polygon, etc., those will fundamentally power decentralized apps, which is Web3.
I want to then talk about several of these meme coins that emerged that I think to a certain extent, would you be able to liken them to penny stocks at all, or would you not draw that comparison? The reason I ask is that when the equity markets are buoyant, when there is a bull market that is on, you have the propensity of small investors to bet on certain prospects that may not eventually turn out. The potential for loss is significant. Of course, the potential for outsized gains is also significant. Would you draw that comparison, and would you say that people are better off not going with meme coins?
So instead of meme coins, I just broaden that a little to mean very, very tiny cap coins, because you're also likening them to penny stock. Regrettably, because this entire space is new and some people think this is a get rich quick scheme, sometimes people don't look at even like one level of research before getting in. As a result, some of these meme coins or micro cap coins actually are, not really very functional, which means in a greater full theory they could go up, but there is no reason for them to even exist, leave alone thrive. And the what makes it worse is that there may be some bad actors who are preying upon the ignorance of some prospective investors and actually offering them fraudulent products. So on the whole, I would say yes, try to remain with the larger names that you hear. You can go into smaller cap, pretty much like in the stock market, there might be treasures there, but only if you have the ability to research them.
There are a few exchanges, and this is a global phenomenon, that have frozen outflows of crypto assets that are held. It has been said that this is against the entire idea of a cryptocurrency as an alternative asset, and that it needs to be completely liquidable. But do you think that liquidity is going to be an issue, that something should that an investor, prospective investor, a holder of cryptocurrency should be mindful of?
So I would like to clarify, because there is while you are technically right, but there is a flip side to it, that most such platforms who have stopped withdrawal, which is what you are referring to, they have not stopped withdrawal for people who are holding their digital asset, let's say in an exchange wallet, and they want it back and they're being told you won't get it. Usually, the places where this withdrawal has been blocked are situations where people had participated in some scheme, such as an interest earning scheme, which means the exchanges or platforms took the coins from you and deployed it somewhere. Now they are not finding it as easy to get it back, hence they can't give it to you. So holding it there has not turned out to be a problem. But despite that, indeed, keeping in with the ethos and philosophy, people should tend to learn how to do self-custody of coins rather than holding it with a custodian.
Thank you for that clarification. My last point, Ajeet, has to do with the TDS that will come into play on the 1st of July. Of course, there's a lot of attention to this, and already in the run-up to this, this deadline or this date, you've had volumes, according to crypto exchanges here in India, that have dropped quite dramatically. What would you say is the implication of this? We knew that this was coming, but once this happens, do you see volumes falling further?
So first of all, is it a surprise that TDS sounds so much like the English word tedious, right? As in, I think it's more than just a coincidence. Having said that, since I told you right up front that 99% of the volumes are trading volumes as opposed to investing volumes, in fact more than 99%, in light of that, now trading high frequency becomes infeasible. There were those who would do it a dozen times a day. Now doing even dozen times a month can erode your investable capital too much. In light of that, volumes will thin down a lot. As in, I think even from here, it's going to go down yet another 75 to 90% from this point, which is already at a fall of 75 to 90%.
So that will happen, but then the final point then, Ajeet, will that push people away from cryptocurrencies? Do we say that Indians will no longer be interested then?
So in the larger cryptocurrencies such as Bitcoin, Ethereum, and a few others, despite the reduced volume, there will still be adequate liquidity to maintain a robust order book. For the much smaller coins, which anyway had thin order books, the erosion of liquidity could actually make the market inefficient, where when you go to buy, the price shoots up as a result of your purchase and falls. So I think that there would be a natural clearing up of the space, which is inevitable in markets which are as immature as the cryptocurrency market.
Thank you so much, Ajeet, for joining in, and always insightful speaking with you.
Thank you.